Hi, and thanks for your patience. I was just had a few technical problems there for a little while. So just get started. We're just going to look at some fundamental analysis that we could use to analyze a stock. And what a good example maybe at the moment would be looking at Tesco, and based on some of the announcements that were made today, with the chairman having been resigned, given the bad earnings announcements in the last couple of months. So just as an introduction, a brief introduction for those of you who may not be familiar with some of the fundamentals we might have a look at today, I'm just going to take a look at just take you through a few slides, some fundamental. Sorry, now just share my screen to you. Just get started. We're just going to look at some fundamental analysis that we could use to analyze the stock. Okay, I want to share that screen. Okay. So the fundamentals we're going to have a look at today will be the price earnings ratio, Tobin's Q, and we look at the beta also. So just as a brief introduction, we'll take a look at understanding what some of these actually mean. So briefly, the price earnings ratio is the most common method used, and it's quite easily calculated given the price and the earnings per share. That is all we need. So the price of the current stock divided by the earnings per share of that stock. And again, we'll look at some of the numbers to see how that might actually be calculated. The historical average for the price earnings ratio, as conducted by an economist, the Yale economist, Robert Shiller, gives a value of 16. So this is seen as a benchmark index. So typically a stock that has a price earnings ratio that's greater than this 16 level is considered overvalued, whereas a stock that has a price earnings ratio below this level of 16 is considered undervalued. And traders tend to maybe look at this simple valuation method in order to establish whether these stocks are valued stocks, something that they might consider to buy into. So historically, the price earnings ratio tends to fluctuate. It's very similar to the stock market because the stock market's price is actually built into this formula. And when the prices fall based on the earnings potential of a company, that might make the PE fall with it. So and that could be considered a valued company, and hence some analysts might recommend to purchase a stock with a low valued price earnings ratio. And likewise, if the price goes up in a situation like a stock market bubble, these prices tend to deviate substantially from the earnings per share of a company, and hence we end up with a high PE ratio. So and that could be seen as an overvalued stock. The only problem with the price earnings ratio is that it's not a good timing device, and hence we may not be able to establish when to exit positions. Here we have a historical chart of the Shiller price earnings ratio, which is considered to be, I suppose, a ratio that's we have in brackets here CAPE, that is cumulative adjusted price earnings ratio. And the reason why Shiller uses this is that sometimes earnings are negative and it can't be brought into the calculation, and you can't really discuss negative earnings. So we have that fluctuation. So that darker line through the chart actually signals that average of about 16. For this current period from 1926 onwards to 2014, we have a 17.5. So any stocks that are above that 17.5 is considered overvalued. And we have situations, say in 2001 at the peak, where we had almost a 45 level that coincided with the tech bubble. Okay, and therefore the stocks are considered overvalued. We have a broken line at about 25 and 10 there, maybe highlighting the relative peak and the bottoms, maybe highlighting overvalued markets or undervalued markets. And at the moment in 2014, at the end of that chart, we see the PE ratio hitting about approximately 25 today, maybe suggesting that markets may be somewhat overvalued based on the earnings potential of companies. Okay, and that's just showing the correlation between the price earnings ratio and the S&P 500 from approximately 1995 onward, and you see it has that similar fluctuation, and maybe identifying peaks and bottoms on the stock market. Tobin's Q, on the other hand, briefly again through this, is a more complicated method of calculating. It's usually what it does is identifies the value of a company based on the value of its assets. So that value of the company may be given by the market capitalization, the share price, and the number of shares, and divided by the amount of assets that that company has. Theoretically, the Tobin's Q should be equal to 1. Empirically, it was found that was approximately 0.67. So we might use one of these two figures as a gauge or a benchmark to identify whether stocks are under or overvalued. Typically, a stock that, or even a stock market that has a value greater than 1, or the empirical value of 0.67, if it's greater than these two figures, the market may be, what we have is the replacement assets of the company being greater than the market value. So these stocks at a figure that's greater, or sorry, that's greater than 1, where the market value is greater than the replacement, would suggest that the market is overvalued. If the Tobin's Q is actually less than these figures, it may mean that the stock is actually undervalued, because the market value, which is the stock price times the shares, in other words, market capitalization, is actually worth less than the replacement value of the assets. And if that company had to go into liquidation and sell off its assets, it would recover a lot more than the market value. Therefore, that company could be seen as undervalued if the Tobin's Q is less than the 0.67, or less than the 1 if you go by the theoretical value. Okay, and again, we see the Tobin's Q and the price earnings ratio are somewhat identifying these peaks and bottoms in the markets. So what I want to share with you then is we may visit that company website, ADVFN, and what would be interesting to look at will be Tesco's current situation, given some of the bad press that's actually that's out there regarding the company. I did mention we wanted to look at another fundamental, which was the beta, and just to briefly say it for this one, we have beta for Tesco at 0.74. So what this means is that usually a stock is compared, the stock's beta is compared to a theoretical beta value of the overall stock market, which is a value of 1. So if the beta is less than 1, the stock is considered somewhat less risky, okay, relative to the overall stock market. In other words, if the stock market fell by 1%, Tesco here would consider to fall by 0.74%. Or if the stock market was to rise by 1%, then Tesco stock would rise by only 0.74. So you see the rises and falls are not as high as the actual stock market. Therefore, it may be considered a lower risk investment for this particular stock. Some stocks are higher risk, and hence they would have a higher beta of greater than 1, say for example 1.5. So that's telling us that if the market goes up 1%, the stock is considered to go up about 1.5%, and likewise if the market falls 1, the stock will fall 1.5. So you see there's more risk associated with investing in a stock with a higher beta than investing with a stock with a lower beta. But the problem with the beta is that this is based on historical calculations, so it doesn't have any predictability in terms of where the stock is likely to go. For financials prior to 2007 and 8, the betas were considered quite low, but from the period 2008 to 2010 or 11, banking stocks had a beta of approximately 2, averaging out now at just over about 1.2. So the beta isn't any past value of a beta does not have any future indication of how risky the stock may actually be. Here we have the price earnings ratio for Tesco to be approximately 14.17. I'm not sure if this is actually updated at the moment. Okay, So all this is, how we calculate it, is it's the current price, which is 171 pence. So this is the way in London stock prices are actually quoted by the penny. And so this is equivalent of £1.71. So 171 pence. And that's divided by the earnings per share to get the price earnings ratio. And the earnings per share that's quoted in this on this website is 12.07. Okay, so about 12 cent. See here is P for, okay, so 12.07 pence. And if we divided that into 171, we get a PE ratio of 14.17. Now we don't know if we can trust this earnings per share figure, because recently it has been announced that Tesco had pretty much lied about its earnings, okay, and its future earnings potential. So there was a kind of a black hole in its accounts of about 250 million. So this has been adjusted, and we may look at an updated announcement based on what was announced today or the last couple of days regarding its earnings per share, and we may adjust the price earnings ratio accordingly. So if the higher the earnings per share, and if this price remained the same, the PE ratio will be lower. So just say, for example, if the earnings per share was 17.1 pence, and if we divided 17.1 pence into 171 pence, we would get a price earnings ratio of 10. So the PE ratio would be considered here to be the value of 10. And based on a historical value for the overall stock market of about 16 or 17.5 since 1926 in the US, so that 10 will be considered as an undervalued stock, and hence it would be considered a buy by analysts. Even at 14, it may be considered a buy or possibly a hold. Okay. Now, what also seems to be great about this stock, and again, I'll repeat it again in a while, we look at updated yields and PE ratios. So we get a true indication of how Tesco is, how good or bad it's actually doing as a company. So here it's considered to be 14, which is a hold or possible buy for this particular stock. A yield of 8.63, this is your dividend yield. What a dividend yield indicates is how much of a return you will get, or how much of a dividend you will receive from the company by buying its stock. And the yield is significantly high at 8.63%. That is phenomenally high, based especially when you compare it against the risk-free interest rate. So the risk-free interest rates in America and the UK are less than 0.5%. So according to this, it's good to put your money into Tesco, because they will give you a very good yield of 8.63. Okay, now I just want to stay on the dividend yield for the moment, because I do want to have a look at possibly some of the other statistics and see. Okay, we're told here Tesco dividends. Okay. Twice a year we have a final and interim dividends. So, okay, so what we have is accumulation of the fiscal year. This is the fiscal year. I know it's not an actual year that we have, so it's the fiscal year is just running in from April of one year to the April of the next. So we have two dividend payments of 10.13 pence and 4.63 pence, with a cumulative payment of 14.76. Okay, so if we got that as a percentage of the stock price, okay, so that should give us the yield, how much of a dividend we're getting relative to the stock price. Now, I don't have a calculator with me at the moment, but this as a percentage of 171p would be quite high, even higher, I reckon, than the 8.63. So I reckon this 8.63 is based on a dividend value that is based on the price, based on the price of a stock on the 16th of April. So I'm just going to go to a Tesco chart to analyze that particular stock price and see what it was like back on the 16th of April. So on the 16th of April, the price of the stock, if you see it in the little square, you'll see the price of the stock here, and the closing price is what we're looking for. So on the 16th of April, we had a stock price of 291.70. So the dividend that was paid out of 14 point whatever pence divided by the 291.7 would give us the 8.63. Now, if you were to look at that dividend relative to the stock price today, it will be significantly high. Okay, that's if the yield is actually based on the 291 or whether it's based on the 171. But either way, that dividend is quite high, and possibly maybe it possibly is based on the anchored the earnings per share. The EPS stands for earnings per share. Sorry, and thanks for the calculation. 11.58. Okay, so the yield is 11.58 based on the current. That's right. Ankit's communicating with me here on the chat roll. So thanks very much for that update. The 11.58 for the yield as opposed to the 8.63. So that's significantly high based on today's price, and you're not going to get that. So we'll have a look at earnings per share and see what the actual EPS is today. Now, so we look briefly at the price earnings ratio, suggesting that it's a buy. Earnings per share is quite good, okay, and the beta is suggesting that's a low risk stock, and the yield is 8.63, or the updated yield of 11.58 is quite significant. Okay, right. So looking at more, we have a lot of fundamentals, but I'm not going to go through them all. But what we want to look at possibly is the Tobin's Q. And if you recall, the Tobin's Q, remember, suggests that the lower the Q, it's considered the stock is actually undervalued because the price has significantly gone down relative to the value of the assets that a company holds. And ideally, you should have a value of 1 if the assets are reflected, the value of the assets are reflected in the price that the traders actually put in for the stock. So looking at the Tobin's Q, here we are. The Tobin's Q is 0.28. And with excluding intangibles for some companies like Facebook would be significantly high because they wouldn't necessarily have the assets or the capital structure that manufacturing, or in this case retail, companies would have. So Tobin's Q of 0.28 is very, very low. And that's telling us that the stock price has gone down considerably and is a very underpriced stock based on the assets. So if Tesco were forced to go into liquidation and were stripped of its assets and those assets were sold on, they would recover a lot more. If you were to spread it out based on the number of shares, they would be worth a lot more than 1.71. Okay, so this stock is considered undervalued at the current price of 171. Okay, so let me have a look at, let's see what we might have regarding Tesco. Okay, let me go back to Yahoo Finance, because I just want to get a summary and see what they actually give me relative to what ADVFN has given us. Okay, so recall 14.17 for the PE, 0.28 for Tobin's Q, and a very generous dividend yield of a recalculated value 11.58, or based on this one, 8.63%. Okay. So, okay, beta not applicable. The earnings per share, 0.12p, 0.12 pence. I'm going to quickly flick over back to ADVFN and see what they actually gave us. So the earnings per share is 12 pence, 12.07 pence. And earnings, the updated earnings value is 0.12 pence. So that is a significant drop, a huge drop, almost a drop of almost 100%. So I would say approximately 98%, 99% if you could do a quick calculation, but I'm only estimating here with some degree of accuracy, I think. So this is quite worrying. And I suppose it's all to do with how Tesco treated its accounts. It had that 250, I think it's 250 million black hole in which it tried to cover up some of the earnings potential of the company. And whatever reasons that was, whether it was management decision to overestimate these earnings. But it's something that is going to affect, as we see here, the PE ratio. Now, how do we calculate the PE ratio again? It's the share price divided by the earnings per share. So the share price 171 pence divided by 0.12 pence gives us a PE ratio of 1,413.22. And that's quite unheard of. Okay. Then we go back to Tesco on ADV again. PE ratio 14.17 based on a price, I believe at the time, maybe the 261 back in April or the 171 here divided by the earnings per share 12p. Okay. So this is quite worrying. This is quite worrying for some shareholders and for Tesco management that a PE level of 1,413 is substantially overestimating the company at 171 pence per share. Okay. So this 100, and just stalling here, Ankit has put in a figure of 100.58. You'll have to explain what you're referring to, that 100.58, Ankit, please, if you don't mind. So 1,413 is relative to the historical average of 16 is phenomenally high. Now, two things are going to happen here. Either Tesco its share price is going to fall a lot further to a value maybe of, I'm not sure, possibly 20 cents a share based on the PE to theoretical price earnings multiple. So say 20 cents per share, or we just say 24 cents a share. 24 cents a share. Let me think. I might have got that wrong. So 24 divided by 12 is only 2. So you're talking maybe about 12p, 0.12p. Yeah. Okay. So you're talking a stock of maybe even a penny stock, really. Okay, so something like a 2 pence divided by 0.12, is going to give you a historical price earnings ratio. That's going to reflect a historical average, I suppose. Okay, so I doubt, not that it could happen possibly, because we've seen about banking stocks, but I think Tesco, even though we have a positive earnings per share, this price earnings ratio at this point can almost be ignored. Even if the earnings per share went into negative or zero, if the earnings per share went into negative, you'll have no price earnings ratio. Okay, so reporting of something like this, if analysts were to trade based on the PE, reporting a negative EPS possibly would have been a better thing to do if you were just solely trading on the PE multiple, because it'll eliminate this PE multiple altogether. Okay. All right. So where does Tesco go from here then? We can't rely on this PE multiple, and if we do, it means that the stock is going to fall to about 2p, 2.5p, based on the current earnings per share. The if that was the case, if the stock continued to fall further based on the value of its assets, Tobin's Q would almost be zero. Okay, indicating a huge undervaluation of the stock. So there's a lot of conflict here in the fundamentals. They just they're not relating to one another as yet. So the company might have to, realizing that its assets are worth more than the stock, may have to consider maybe selling some of those assets in order to generate extra cash or income. And what would be good to look at is how Tesco are dealing with maybe their assets or their liabilities. Okay, how they're financing these earnings as well. These earnings. Some of the ratios here. Okay, we have a high debt ratio. It's net gearing. It seems to be a highly geared company. Okay, so that's there's a high levels of debt. So any of the earnings, you could look at earnings in a number of ways. If earnings are quite high and quite good, and we'll assume that they're good for Tesco given what we have reported here, earnings of 12p. You need to look at the numbers behind this 12p earnings per share, because at times the earnings could all be created based on the high levels of debt. And if there's high levels of debt, these will have to be repaid sometime in the future. And that could, that could cause some problems for a company. If there was lower levels of debt and the earnings per share were healthy, as we might have here 12p, then the company would be on a strong footing. But these high geared company is worryingly have to repay this, and that might again result in selling off some of its assets, because its assets are worth something according to Tobin's Q. So it could be a good way for this company to sell off and repay some of its debt. I want to see what its debt looks like actually. Okay, it's down. Okay. Okay. There's been marginal increases in the creditors, the liabilities that it has. Okay. Okay, we've seen the short creditors that has increased. We're talking about 2011 up to 2014. So we see an increase in the amount of creditors used, and also in the long term. So this possibly could be quite high for a company, especially when the products that they're selling would like to have low levels of stock. So their stock levels are quite low, because they're selling into mostly perishable goods market. So they should be able to pay off some of their creditors. And this is worrying for some creditors that, I don't know what the creditors' days looks like here. I'm sure it can be calculated, but whether Tesco are, they should try to reduce the amount of creditors that they have on their books. And again, that might have to result in selling off some of its assets. I know based on today, we have some news regarding Tesco. Okay. Okay, we have the chairman resigning after the accounting scandal. Okay, and what's this here? Needs to create financial headroom. In other words, it needs to clean up its books. Okay, it's something I didn't mention. Pension deficit wouldn't necessarily be noted on the website we were looking at. So it needs to bolster its balance sheet. So it needs to And that doesn't mean take on more assets, okay, because that means taking on more debt. And what it has to do is reduce its liabilities. And in order to reduce its liabilities again, there we go. You might have some disposals of assets possibly. It's not going to do price cuts, okay, because unless they're trying to compete with some of their competitors. Okay, so debt has risen. Non-current liabilities or long-term borrowings, they've increased. Something we just highlighted there. And they might look at asset disposal in Asia. Okay. So I just want to see if there's any more that might be of interest. And I might jump over to another stock to see what they actually give us. Some of these you might be familiar yourselves if you were dealing with financial accounting or financial ratios prior to this sitting, and liquidity ratios and current ratios. And again, they're not healthy at all. Okay. You're looking, you want a liquidity ratio of 1 and a current ratio of about 2 to 1. Possibly a quick ratio of 2 1 here, the asset test. And that's your assets, your ratio of assets to liabilities. So, you know, here it's you're taking on possibly more liabilities than you have assets. So that's under the value of 1, which is not good. And your current ratio, ideally, theoretically, it should be 2 to 1 in terms of your assets and your liabilities. Again, that's 0.88, and that's an extremely poor ratio. So it's no surprise that Warren Buffett cashed in his shares. And again, it still doesn't look good for the company. And the only thing that seems to be given some glimmer of hope for Tesco is the Tobins Q. Personally, I think this is the only glimmer of hope. And this is suggesting that the stock valuation of the company is considerably low relative to the replacement cost of its assets. And that's pretty much the definition of Tobin's Q. So at least it has to have the assets there. The only thing that could affect Tesco if it maintained its assets is that if there happened to be a property price crash and reducing the value of those assets, which would actually bring this back up again. Okay, so 2 things can happen. Either there's a huge I suppose diminishing value or a crash in terms of property prices, or there would possibly Tesco prices need to increase. Lee has asked me a question: would I try to short Tesco, or would you stay away from it completely? I think there's going to be a lot of volatility in Tesco, like the way it has been at the moment. Based on if I was a fundamental trader, I would stay away from Tesco. Okay, I'm not even sure about shorting because there's other opportunities out there. Okay, from a technical perspective, I'm not sure what the diagram shows. And that could give you some other indication, or it could even support what the fundamentals are telling us. And right here, the technicals are telling us to forget about Tesco based on the 1 year trend on the way, the downtrend. So even though all of these news announcements have only been hitting recently, there's something going on. The price indication here was just all along was to sell that particular stock. Okay, so if you look even here, we have almost a double top. The second attempt never reached above the previous one. And maybe if you put in an RSI, or the RSI is done anyway, that could give us more indication as to, you see the downtrend in the RSI, and it's meeting with the downtrend in the peak prices here. So Tesco was pretty much a sell-off back in the end of September, early October 2013. Okay, we have a huge gap occurring here. I'm sorry now for going off the tangent and looking at technical analysis, but I'm just trying to address a question that Lee has given me. We've seen gaps here, and to me, that's an indication that they could be filled. What's also seems positive right now with Tesco is that just like the way we had back a year ago at the double top, we have what's here a double bottom. And the bottom here is higher than the previous bottom, which may suggest that we've hit a low and this stock could rally further. And it could rally up to the point to cover these gaps. Okay, so we could see a price target for Tesco in the medium term of possibly about £2.28, or maybe even covering this next gap of about £2.48. The relative strength index is indicating a huge oversell at this bottom here. It rarely would even reach a value of 10. Okay, so there's a huge oversell position, and that next bottom is approximately here. And you see the relative strength index is getting higher and higher. So if I drew a line here and I drew a line here, at the moment Tesco, based on a technical perspective, has reached its bottom. Okay, but the fundamentals is indicating other things. Tobin's Q would actually, if we went to try to look for confirmation, and if you're biased in terms of one of the heuristics in behavioral finance, confirmation bias would suggest that you're going looking for information that tries to confirm and validates your thinking. So based on a technical perspective, yes. Based on Tobin's Q, it's also a yes, because the stock is hugely undervalued based on its assets. But all the other variables don't look good. And what's another fundamental is actually the chairman or the CEO of Tesco step down. And there's going to be a change. And usually with a step down like that, it gives a positive reaction to the stock. But this stock has been a sick stock, or it is over a 4 or 5 year period. It's not good. It's not good. There's a rapid decline. Even here you've seen, look, Tesco hasn't been good all along. It was never a buy. Like, I'm just wondering when Warren Buffett bought into it. Was it here? Was that Warren stock sell-off? I can't remember when Warren Buffett actually sold off. Like that. Sorry, now I just want to answer Christina's question. Was that possibly due to Warren's sell-off of stock? Okay. We have a share sale of field. I honestly don't know when this actually occurred. We have a March 2nd, 2014. So back then, prior to March, he sold a lot of it by almost 30%. Okay, so and we know he has dumped a lot of the stock lately as well. So that's hitting around the March level. So if that's the case, that was announced by The Guardian on the 30th of March here. And we have a gap downwards here. So Christina, you're probably right to point that out, because we see a gap, and that's a huge sell-off in Tesco, and that could have been the Warren Buffett effect, I suppose. We also heard that Warren Buffett dumped a lot of his stock, and that could have been it here. And when that was announced, if it was announced thereafter, because he's not going to be telling people that he will dump it because they'll get in there ahead of him, it'll only be announced afterward, that it might have had a knock-on effect. So that news could have filtered through around this time in the marketplace, that Warren Buffett dumped stocks. If I'm saying he dumped it around September 11, 2014, people could have panicked, I suppose, that he's actually done it again. And there might have been a huge contagion effect and a further sell-off. So like that, there's always situations where the stock, based on the RSI, has either been oversold or overbought. Okay, so there's an overbought position in this particular stock, coinciding with a peak at that point. Okay, even though the RSI is indicating positive, but we have what's called, if we remember from last week's webinar, this is a shooting star, and a shooting star seems to indicate a peak And this is coinciding with the peak in the RSI as well. Okay, so yeah, they're quite good questions. So it's almost a confusing stock to decide whether you want to invest in it or not. Fundamentally, it's a no. It has to sort itself out from a technical perspective. To me, it seems to be yes, even though the trend still seems to be downward. Looking closely, there's a double bottom, and RSI is increasing as well. But if that was the case, identifying the bottom of these levels here, if you look at the square that we have on the top left of the screen, the low on that is 168. So if you were to buy Tesco, I would be putting it in a stop just below that low level of 168. So approximately maybe 160, 162, maybe even 150, 58. I'd be putting the stop loss in here. Okay, just in case it does actually fall down to a possible 24 cent a share based on a new PE ratio or a 2.5% P stock. That's highly unlikely going to happen unless it actually cannot, if the Tesco cannot maintain its payments on its on the creditors that it owes money to, because these creditors could actually force Tesco to go into liquidation if they want their money back, and then they would go into administration, get protection by the courts in order to stop the selling of his assets. So I know it's kind of creating a doomsday scenario for Tesco, but with a new CEO, you might start seeing sell-offs in the assets that Tesco actually have. So maybe that's enough for the moment on Tesco. Let me just see if we have something different on Facebook, because I may be picking something like someone like Facebook. If it can give us some information, it might be a good idea to do this, and I'll do it quite briefly, only because Facebook and Tesco are totally different companies. Tesco has high levels of assets, more tangibles than intangibles, whereas Facebook, I think, would have the opposite. They'd have more intellectual property, a lot of software and so on. So you may have more intangibles relative to tangibles. So Facebook being a kind of a software company as opposed to someone like a bricks and mortar company like Tesco. So it'd be interesting to see the differences between the two. Okay, we're not given a data here. Stock $80, earnings per share 62 cent. Remember now, this is different to the way it's quoted in the UK. $80. If this was quoted in London, it'll be 8,018 pence. Okay, so in the US it's $80.18. The earnings per share is 0.62 cent, which is quite decent earnings per share. I'm not sure why there's no beta here. The price earnings ratio is significantly high relative to the historical average of approximately 16. So fundamentally, this is an overvalued stock. Okay. Dividend, you'll notice that there's 0 cent being paid out. So that's that there's nothing wrong with a company not paying out a dividend. Maybe Tesco shouldn't have been paying out dividends all along. Maybe should have been retaining those dividends and retaining those earnings and reinvesting and paying off its creditors rather than having high levels of debt. So they should have been retaining those earnings. So company doesn't. It's not legally obligatory, I suppose, to pay dividends. So again, for Facebook here, 62 cent divided into, okay, that's $80. Okay, nowhere. Okay, 100. Yeah, so 62 cent divided into $80 is going to give us a PE of 124. Okay, and to really put a perspective on this, to really know what a PE means, rather than comparing it to the benchmark. A PE in this case of 124 means that you're paying $1 to you'll be paying $124 for every dollar of earnings. Okay, so if a company is paying, say, earnings of $1 every year, it'll almost take you, say, 124 years to get your investment back. So that's what we mean by a high PE is actually overvaluing a stock, because you'll never get your return on your investment based on the earnings of the company. So Facebook, their earnings are significantly low relative to the stock price. What else? Tobin's Q. If to have it. Okay, Tobin's Q ratio of 11.43. That's quite high. Okay, that's telling us that the market share of the stock is higher than the asset value. This should be theoretically 1. And if it's over 1, anything over 1 is an overvalued stock. So this is significantly higher than the value of 1. Therefore, Facebook is ridiculously overvalued. So that again conforms with the idea that the PE indicates also a high value stock. Okay. Let me see what else. Now, the thing is, we don't have a breakdown of the Tobin's Q, unlike the Tesco where it had excluding intangibles. If we had excluded intangibles here, okay, I'd say you'd have a significantly higher Tobin's Q. Okay, because I wouldn't say, usually their assets are mainly headquarters, like the way we have offices in Dublin and so on. Okay, so and again, a lot of their technology, their hardware will probably be depreciating in value, so they wouldn't have the value that a building like some of the Tesco retail stores would actually be able to hold and even gain capital appreciation. So a lot of the assets that Facebook would have depreciating assets. So again, Facebook to me is considerably overvalued. I just want to see, is there anything in terms of other liabilities? Maybe I'm not sure if I'm missing it. Okay, per share, liabilities per share, 0.64. I want the rate in percentages. This is showing PE ratios, quite significantly high. High again, but relatively low. But again, you know, they're just showing historical PE ratios. So, you know, either to justify holding Facebook stock, they want to be increasing their earnings significantly in order to reduce the PE level. So I see Facebook as I wouldn't based on fundamentals. There's no way a buy. I'm not sure where. Okay, its current. Now, having said that, its current ratios are quite good. Assets to liabilities. Okay, I know it seems almost contradictory regarding its assets, what I was saying about its hard assets, but you know, assets can be intellectual property and patents and so on as well, especially for a company like this. So they could be overvalued either. Okay, so we know that some companies, software and hardware companies that have patents, can actually sell them at large profits because they are protecting some of the intellectual property that they have, or some of the copyright. So again, a company like this could be overvaluing some of the assets that they actually have, especially the intangible assets. So even though the current and quick ratio are fantastic because they're usually 2 to 1, and this is 12 to 1 almost, and this quick ratio is 1 to 1 and 11 to 1. So according to that, Facebook has no problems. Okay, if it was ever to try and meet its liabilities. Again, long-term liabilities, there's nothing. So this seems to be, if I'm correct with that, I find that hard to believe, but if I'm correct with that, it seems to be quite a healthy company. But I'm sure there's a lot of a lot of emotion in terms of traders holding onto the stock, and maybe it's that Zuckerberg owns a large percentage of Facebook. So I'm not sure exactly what his percentage holding is in terms of stock, but he does own a large percentage. And because they're withholding a lot of those shares from the market, and people are trading on the remaining shares that are being pretty much traded on a daily basis. So that creates a shortage. So if Zuckerberg was to release his shares onto the market gradually, you'll have more selling relative to buying, and that could bring down the price. So Zuckerberg could effectively be what we might call cornering the market, where you start trying to retain a lot of the stocks or a commodity and not sell them onto the market, and thereby bidding up the price and then releasing them later on. I doubt Zuckerberg is doing that, but there's a possibility that could be justifying why prices are quite high, because a lot of traders out there are trading on a lot of whatever shares that are made available, while Zuckerberg could be retaining a lot of his stock. All right, here's the balance sheet. Okay. So this is quite different to the balance sheet of Tesco. They had more to red, significantly. It was a huge proponent of this makeup on their balance sheet. So I've mentioned about intangible assets, and intangible assets are quite small. So if I was to backtrack on what I had said, I would say that the Tobin's Q is quite justified in terms of the hard assets that it may have instead of the intangibles, but that's still hard to believe based on given the fact that Facebook is not a bricks and mortar company like Ford and Tesco and so on. So I don't know. I'm not really sure about that. It has a lot of cash. Maybe this is if this was taken out, we might have a larger percentage here. So this large cash or cash equivalent is dwarfing this actual figure. So it's a very cash rich company. Okay, and possibly that dwarfs all these assets. When we were looking at the current ratio or the asset test ratio, these assets are dwarfing the liabilities that's in there. So the current liabilities are here, and you have your assets dwarfing that. So that's why we have a very high ratio. So they are well covered in terms of having to repay back any liabilities that any creditors that they may owe, unlike Tesco. Okay. I'm not sure if there's anything else. I know there's still a lot here. Okay. I just wanted to take you through maybe a couple of examples of, and it was probably a great coincidence, really, that some of these announcements took place today regarding Tesco. And we have this website we're currently on, ADVFN, have not updated the announcements regarding its earnings for Tesco, whereas Yahoo Finance have done so, and suggesting again that the company is still remarkably overvalued. Okay, so I suppose to summarize all of this, really, we're looking to when we looked at the webinar from last week, technical analysis, even though we didn't cover much, likewise we couldn't cover much on fundamentals, but based on what we had done, there seems to be some kind of conflict in the examples we looked at today. They tend to go hand in hand, but what would be good is, from an analyst perspective, is to view a stock in terms of both its technicals and fundamentals. The fundamentals are given red flags for Tesco at the moment. Things don't look bad at all. Things look don't look good at all fundamentally. PE quite high, earnings per share is significantly low, suggesting the stock should even fall down to about 2.5 pence, as opposed to 171p, the current value. But the technicals are indicating a different story. They may be indicating a turnaround in the market. from its highs, and we've seen that huge downtrend over the last 5 years for Tesco. We've seen a double bottom, gaps prior to that which could possibly be filled, and if I was a technical analyst, I would have a target of approximately 258 pence for Tesco. Okay, I would bring that down maybe to whatever that first gap was, but the second gap I think was about 258 pence. So technically Tesco is a buy. Fundamentally it's not. The Tobin's Q seems to suggest that Tobin's Q for Tesco seems to suggest that Tesco is also a buy, confirming the belief of, say, a technical trader. But everything else regarding Tesco is not. It has good assets there, so it needs to sell those. Okay, but Tobin's Q of 0.28 is saying that Tesco is hugely undervalued and it's possibly a buy at this point. So usually you might have to become what's called a contrarian investor. And that means going against the mass thinking of what others are actually perceiving the stock to be, which is sell, 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 because Warren Buffett has done it. It keeps on hitting bad news, but there's going to be a point where there's going to be a turnaround. The RSIs are significantly low, they're rising, double bottom, the second bottom was that bit higher. So being a contrarian investor are going to be those people who are actually going to go against the crowd when everyone is sold out. They're the ones that are buying back in. And just to conclude, we looked at Facebook being a no regarding a buy based on its fundamentals. And it'd be just interesting to see, since I wanted to avoid a technical perspective here, but I just wanted to see whether Facebook is actually a buy in this case. And does it go against the fundamental thinking of being a sell? So the momentum is quite strong. If I was to draw lines in here based on last week, they'd be kind of hitting off. Maybe we start back here. So we'd have a line probably going across the bottoms, and it broke down below this line. And at the moment, it's testing this line. This line was a support and has now become a resistance line. So if that was the bottom of that particular line that's being drawn at a diagonal, Facebook is trying to get above it. If it settles above it and bounces off it, we may still see a continuation of this trend. But at the moment, there could be changing conditions in terms of the Facebook stock, and we might see it going lower. We might even see this heading down toward a $65 level. But again, if you were to short Facebook, I would use this diagonal line that was drawn in here as a target for a stop loss, which would be slightly above. So short in Facebook at this point, with a stop at maybe a couple of dollars or $1.50 above the current level. Would stop you out if you're actually incorrect regarding your market. We see a gap here, and that's being filled down here and made its turnaround, and it may be a point where there could be some degree of weakness. Again, I just want to see what the RSI is like. Okay, there was not that huge of an oversold, but here we're seeing it heading towards an overbought position. Okay, so we might see a slight movement on the upside, but according to this, the trend seems to be going on the upside, but there may be some weakness ahead. So if you're going by that last resistance line, it's a short, temporary short with a tight stop. If it breaks above it, I could see a continuation of the trend on the upside. So Facebook, if it does break above that resistance line, is still a buy. And again, that seems to go against the fundamentals. So again, some conflict here, but I wouldn't buy the stock just yet unless I see it reach a new high and settles quite above. So there, again, it's a patient game, and you may not want to buy into this for another few weeks. Okay, I could possibly see this heading down, as I said earlier, on to about $65 level. Okay, if it fails to stay above that diagonal line I just drew, because it did break down below it, and that's quite a long term. Okay, that's a long term trend. That's it's moving. That the stock is moving, and it did break down below that trend. Okay, just like the way it's done here. If I drew a line from this low through these points, you see it actually broke down and now it's failed to actually go above that line again. So it was trending here, now it's trending here, and it possibly could start trending at a lower channel to the upside. Okay, so again, I wouldn't go near Facebook solely because the fundamentals are indicating that it's a hugely overvalued stock. Its price should significantly come down, but I think there are too many investors or traders who may be emotionally attached to it and actually want to retain shareholding. Okay, I'd like to thank you all for joining me again on the webinar. I really appreciate you, and I really appreciate you joining me here. I know you could be doing other things, but you know, it makes this worthwhile when I see you actually interested. Thanks again, and maybe I'll keep in touch with you again soon. What I actually personally wouldn't mind doing is some econometrics. I know some of you are working on some econometrics, so I must install the Excel package on my Mac, so so I could actually work on that one, and just go through maybe how to use the correlation regression analysis and understanding some of the T statistics. So maybe add a little bit of variety in there for some of you who are doing econometrics, and even those people who are not doing econometrics. I know you might be looking at doing it for some of the research that you'll have in the future, the near future. So it would come in handy to have something like this, to attend something like this. And I can go through how you might actually even gather data as well, and work through that particular data and what you need to do, such as doing if you're working with stock data, you need to get in log prices, for example, and calculate returns and do some kind of some type of analysis anyway, and get familiar with the data analysis tool back on Excel. So, okay, thanks very much, and good night, and have a good week.